are long-term growth investors who think about risk as the risk of losing our clients' capital rather than deviation from a benchmark. And this really leads us to take a truly active view to finding high-quality companies that are run by high-quality people that we can own for the long term. And if we're looking to own a company for 10 years, we find ourselves asking relatively simple questions like, do we trust the people? Are they competent? Are they aligned with our time horizon? And do they think about risk like we think about risk? And this is done because we believe that over the long term, it's the quality of the people at the top of a business that will decide whether capital is grown or capital is destroyed. And similarly, we're asking questions about how a company is positioned over the next 10 years relative to the many multiple headwinds and tailwinds that come from a need to shift towards a more sustainable form of development. And these trends are even more acute in Asia. So in terms of outcomes, we are taking a truly active view to building the portfolio. It's built from companies that we believe to be high quality, that are run by high quality people, that are well positioned for sustainable development. And this tends to mean that the Pacific Assets Trust looks and behaves very differently to the benchmark and other Asian investment trusts out there. Well, as an outcome of our focus on risk as being the risk of losing clients' capital and the time and care we put into ensuring that we're owning high-quality companies run by high-quality people, the trust tends to outperform in down markets. If we were to look at rolling 12-month periods since we took over managing the trust in 2010, the Pacific Assets Trust has outperformed in over 90% of down markets. Conversely, the trust tends to underperform in a relative sense fast rising markets that tend to be fueled by greed or animal spirits. And the types of companies that we don't own will tend to outperform in these markets. And we saw that in 2017, where the Chinese internet companies that we didn't own went vertical and drove Asian markets higher. Similarly, in the post-COVID crash recovery, these markets were driven by the types of companies that we would not be comfortable handing our clients' capital to. But I think what is important is that we never aim to predict what will happen to the market over any short-term time period. The results of capital preservation in down markets and underperforming fast-rising markets is really the result of us trying to build a portfolio that is robust and resilient to most macroeconomic environments, while also holding companies that we believe can create significant growth over the long term. So if we are fulfilling our job as being passionate, curious investors, we should really be open to ideas coming from everywhere. We have never found that putting the investable universe through a quantitative screen has been a source of great ideas or certainly differentiated views. That's a very popular tool and tends not to offer differentiated ideas. Given our focus on people, we have found rich veins of ideas just following good people, whether that be management teams or board members, people that we believe to be very high quality. We will become intrigued by where they go and we follow them as a source of new ideas. Similarly, we get very excited when we find a good company where a new management team has come in and we believe that that management team can take the company from good to great. And again, I think our ability to be truly active, long-term, and with an emphasis on people, it allows us to get attracted to these types of companies and these opportunities when other quality investors that may have a more quantitative approach would have to wait for the numbers to come through. We're relatively fortunate that we can back companies far earlier in their journey if we can get comfortable with the evolution that the management team is going to take that company on. In regards to holding periods, we are asking when investing in a company, how much is this company worth to us over the next 10 years? And if you look at the average holding period of the top 10 positions in the trust today, the average holding period is 9 years. So hopefully there's some evidence there that we're walking the talk in terms of being a long-term capital allocator to Asia. So this is just an outcome of us looking to find high-quality people that we can trust to look after our clients' capital. Over 80% of the holdings in the trust have either a first-generation entrepreneur, a family, or a trust as a material owner. And these stewards have generational wealth, family reputations and names on the line, and importantly, they've been around for a long time. They've survived multiple business cycles, multiple political transitions, the whole spectrum of interest rate and inflationary environments, and they've survived and prospered through that because of their view of risk. So they tend to, they're thinking about risk how we think about risk, thinking in absolute terms, and they're looking to build businesses that can preserve wealth and grow over the next 10 years and the next generation in some cases. And this really runs counter to a state-owned enterprise or a company where you have a short-term management team who is incentivized on next quarter's earnings. These two sets of individuals are making very different decisions, and we believe create very different outcomes over the long term. And we are seeking to give our clients hard-earned capital to these individuals that are stewards of capital and are focused on building a business over the next 5, 10, 20 years. So this is, again, an outcome of our want to ensure that the portfolio is always a reflection of where we see the best opportunities bottom up to preserve and grow our clients' capital. If there is a company or a sector or a country that we're uncomfortable investing our clients' capital there, we will not invest. Even if that country, sector, or company is a significant weight in the benchmark. At the moment, we're relatively lucky that there's a rich vein of opportunities in India for us to invest in. We come across a large number of high-quality companies that are run by very high-quality stewards that have the opportunity to benefit from a number of long-term growth opportunities. But that's also not to say that every Indian company in our eyes is investable. If you look at the top 100 companies in India, we would reject 75% of those on quality grounds. But for those companies that we do own, we have world-class financial institutions benefiting from the growth in financial inclusion in India. We have industrial companies that can go toe-to-toe with global multinationals. And we have healthcare companies that are improving patient outcomes while reducing overall costs in the system. And we believe that's a vital role to play in the development of a sustainable healthcare system in India. In China, there just isn't that depth of opportunities for us at the moment. The largest companies tend to be state-owned or implicitly state-controlled, and we really struggle to hand our clients' capital to those types of businesses. So again, if you were to look at the top 100 companies in the A-share market, we would only deem 2 or 3 of those to be investable. The types of companies that we want to be handing clients' capital to are companies owned and run by entrepreneurs with great franchises, with great balance sheets that are exposed to attractive long-term tailwinds, but importantly that are operating far from the heights of the political economy. To finish up there, the Pacific Assets Trust should always be an outcome of where we believe there are the best opportunities for the long-term preservation and growth of our clients' capital. The allocation to a particular sector or country will never be based on a top-down view, and certainly never based on a particular allocation in the benchmark.